We are now, in my view, entering a period of instability for credit, which in many ways is kicking off in the same way as we saw in the 1970s. And I think that's the most important message for anyone looking into 2024, when they're sort of thinking gold's going up. No, it's credit. All the risk is in credit. And it is because it has become completely detached from reality. Let's put it that way, let alone describing reality as gold.
Alasdair Macleod, head of research for Goldmoney and SchiffGold, has highlighted a concerning trend in the credit market, drawing parallels to the economic instability witnessed in the 1970s. He dismisses the notion that gold's trajectory should be the primary focus for 2024, instead emphasizing the importance of monitoring the credit state. Recently, the dollar index reached a 5-month low of 101.6, indicating a second consecutive weekly decline, attributed to expectations of future interest rate cuts by the Federal Reserve. Simultaneously, the price of gold has surged to a multi-week high above $2,060, fueled by a negative 10-year US Treasury bond yield below 3.9% following soft US PCE inflation data. Reflecting on the 1970s, a period marked by sharp increases in gold prices, Alasdair notes that this rise coincided with higher and rapidly increasing interest rates. As we approach 2023, gold prices have shown signs of recovery, reaching $1,900 per ounce in mid-January amidst moderating inflation and expectations of a slowdown in Fed rate hikes. Alasdair's analysis delves into the complexities of the relationship between high interest rates and gold, challenging conventional wisdom. He also explores the practice of gold leasing by central banks, particularly the New York Fed, raising concerns about the potential long-term consequences within the financial system. In the broader global context, reported net gold purchases totaled 42 tons recently, a 41% decrease from September, but 23% above the monthly average for January-September. Notably, the People's Bank of China has consistently been the largest purchaser, adding 23 tons to its reserves, bringing its year-to-date net purchases to 204 tons and raising reported gold reserves to 2,215 tons. Reported net gold purchases signify the broader geopolitical landscape. How might it influence global economic dynamics? Let's delve into key moments from Alasdair Macleod's interview with these video clips.
It's very, very simple, Tom. I mean, we went into the 1970s with gold at $35 an ounce, and the Fed funds rate was about 5.5, 6. It subsequently went down to about 3, but then it rose at the end of the decade to, 19? And what was the price of gold at the end of the decade? It hit 850. The idea that, high interest rates are bad for gold, I think can only really apply in an inherently stable credit system. In other words, a credit system where there is very little threat to the value of credit from whatever economic developments that may be in the pipeline. And this, of course, was the difference between the 1970s and the decades that followed it. In the 1970s, we came into the sort of world of fiat currencies. There was considerable uncertainty. You had rocketing oil prices and all the rest of it. And so there was this period, if you like, where faith in the fiat currency was by no means guaranteed. And there were times when that faith came under very, very strict pressure. So under those circumstances, yes, there is absolutely no link at all between what, let's say, a dollar pays you, a dollar deposit pays you, and what you would get on gold, let's say, by leasing it out. Typically you're looking sort of 5, 6, 7, 8%, as against a gold lease rate of, sort of 0.5% to 1.5%, maybe even 2%. That spread at times of uncertainty and concerns about the purchasing power of a fiat currency, that differential is completely meaningless. But if you have a stable situation, such as we had, particularly in the latter part of the 80s, through the 90s, and so on, then if interest rates rose, then what you were looking at, quite simply, was the bullion banks would, if you like, buy gold or obtain gold through leasing, sell it in the market, The cost of the lease was around about 1%, maybe 1.5%, and they could invest it in US T-bills to get 6%. Mm-hmm. And it was a big carry trade. I mean, it really was. This was behind the stories, which, so far as we can see, have been actually very, very well documented as being correct, that the central banks were leasing gold into the market, such that by 2002, Frank Venerosa, the analyst who really looked at this in great, great depth, reckoned that anything between 10 and 14,000 tons of gold had been leased into the market. And the way he put it is probably adorning the necks of Asian women. In other words, it had gone forever. I don't think that subsequent to that gold has gone out of the system in that way, quite in that way. But there's no doubt about it that there is still this black hole of leased gold. Now, that 14,000 tons in 2002 was half total world gold reserves. Today, I don't know what the figure would be, but certainly the behavior of New York Fed when it came to Germany demanding its gold suggests that some of the leased gold had actually disappeared, if you like, from its vaults. And it had compromised the position of the Bundesbank and probably various others.
In the heyday of the Bretton Woods system, gold was the anchor for the US dollar, with other currencies pegged to its value. However, the system met its demise in the early 1970s when President Richard M. Nixon announced the discontinuation of gold for currency exchanges. According to Alasdair, the subsequent separation of credit from gold, spanning over 5 decades, has been driven by propaganda to diminish gold's significance. This shift in perception and practice has detached gold from its historical role as a cornerstone of monetary value. It's important to note that gold held under earmark at Federal Reserve banks for foreign and international accounts is excluded from the U.S. gold stock, valued at $42.22 per fine troy ounce. Alasdair underlines the enduring legal status of gold as money, referencing historical figures like J.P. Morgan, who asserted, "Gold is money, and the rest is credit." J.P. Morgan's distinction between money and credit is pivotal. Gold, unlike credit, doesn't rely on a third party to fulfill a promise. It is a tangible asset, while credit remains essentially a commitment. Let's get back to the interview.
You have to bear in mind that gold is legal money. I mean, the eponymous J.P. Morgan himself said, gold is money and the rest is credit. Mm-hmm. That was true in 1912 when he made that statement, as it is today. Legally, gold is money and the rest is credit. The problem comes when you detach credit in terms of its value from gold. We've been like that now for 52 years. And the only reason that this detachment has lasted this long is because of the propaganda and the bullying efforts of the American-led financial system to try and dissuade us that gold has anything to do with the financial system anymore. It's a pet rock, they say. Mm-hmm. No, if you delve into the law, you will see the reason, for example, that it's on the balance sheet of the Fed at $22.22 to the ounce is because that is the official price of gold. I mean, if gold was a pet rock, it wouldn't be there, or they would value it at market. But no. So, and this is also why, when it came to the Bretton Woods agreement, Nixon could only suspend it. He could not completely deny it or follow it up with legislation saying gold is no longer money. Mm-hmm. No. And this is why we have, in our currency, we have a statement on our paper notes saying, I promise to pay the bearer the sum of, and it's a £10 note, £10. And that is in gold sovereigns, by the way. That's 10 gold sovereigns. Promise from the Bank of England, and it's signed by the chief cashier. Now, that is still on every banknote because it is a legal situation. Mm-hmm. Gold is money, the rest is credit. And this is why I think it's desperately important for people to realize it's not gold going up. It's their dollars, their pounds, their euros, the yen, whatever it is, going down. And when they go down and there is nothing to stop it going down because of what their government's doing to their currency, there's going to be no end of it. And I can't really see any practical way in which the US government in particular can return to the situation. I mean, from every which way, Look at the fact that they've been denying that gold is money in defiance of the legal position. You have the whole of the economic establishment not understanding the difference between money and currency. You have got the geopolitical situation because the Russians and the Chinese understand that gold is money. They've been accumulating gold for that reason, and they have substantial reserves which are not declared as official reserves on the balance sheet of their central banks. The geopolitics of a dollar price shooting up from the American point of view, are just too horrendous. They're not going to encourage it. They want to discourage it. But they've got a problem. How do they deal with it?
Considering the ongoing accumulation of gold reserves by nations like China and Russia, what geopolitical shifts could arise, and how might these impact the balance of power in the international economic arena? As gold's legal status endures, as highlighted by Alasdair Macleod, how might governments and financial institutions reassess their approach to gold in the future? And what implications could this have for the stability of fiat currencies? Share your thoughts in the comments section. If you liked the video, please subscribe to our channel, and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.